Hello again. The last time I spoke to Anita Paluch, she made a very good point. Germany cannot escape its neighbours. So, is the engine room of Europe being dragged into recession by its neighbours? Well, I've been speaking to Anita from the offices of Gekko Global Markets. Let's talk about Germany. The picture in Germany isn't so rosy. The GDP data last week came in slightly below par. Now, the PMI data is okay, but it's still below that neutral 50 level. So not everything's perfect in Germany at the moment.
Not at all. As you mentioned, the picture isn't that rosy, as we have seen until now, until very short time ago. Germany was quite insulated from the troubles plaguing Eurozone. However, as we have seen most recently, the GDP growth as such has came out almost at a flat line. So Germany is feeling the pinch of the Eurozone troubles, and as such, the data it's pointing to rather bad picture. Well, not bad. It's actually worse than we would expect from an economy that is supposed to be strong and the leader in the Eurozone.
Yeah, and what about the PMI data? As I said, that it did come in slightly better than most people expected, but that we can't ignore the fact that it's below the neutral mark of 50.
That's correct. So the PMI data, although slightly improved in comparison to the expectations, are still pointing to a contraction of a territory. So it's not all that good, and as I said previously, Germany is feeling the troubles going on in the Eurozone. However, this might not be such a bad thing in the whole picture, because if we consider Germany was until now the biggest obstacle in the talks on how to solve the European Union troubles, we might consider if the country itself has to make decisions whether to actually turn into the growth path. This might actually help the Eurozone to come to a solution to solve the troubled countries' Euro members.
Yeah, that's quite interesting. It could motivate people like Angela Merkel, because when their economy is actually suffering, and that's the ultimate motivation, isn't it?
That's correct. Yeah. Well, if Germany starts to sympathise with other members who are actually not as well off as Germany itself, then actually might start thinking about, okay, shall we now turn into growth path, or shall we still stick to the austerity measures? And as we have seen most recently, these are kind of misguided concepts. The consequences of this policy, of the theology of austerity, has brought many people into the streets. Last week we have seen strikes and trade unions going out to the streets opposing to the austerity measures being imposed on them.
So I suppose the question is whether we're at the bottom of this German data, or is it a case that we could go lower still?
That's a very good question. As we have noticed, the data has come out slightly better than expected, and we had very positive impulse from China today as well. As we have seen, China has peaked out above the 50 level, so that's a very good improvement. And considering the tides Germany has got with China, it might actually improve the whole picture. So in the whole picture, we see that actually China is stimulating a bit Germany.
Sure. And what about France? The French data was also better than expected, but The Economist did a big splash last week saying that France is the ticking time bomb of Europe. Is that a view that you would share?
Right, France, yes. Last week, The Economist actually compared France to a ticking time bomb, which has a certain degree of correctness to that. The numbers today that we have seen, yes, true. Again, they came better than expected. The manufacturing data has came out better than expected. However, the service part of the PMI data has pointed to a softening. So it's a mixed picture.
Yeah, and what about the EU budget? David Cameron's going over, apparently, to bang his fist on the table and doesn't want any above-inflation rises to the EU budget. Is it actually an event which concerns the markets?
Surely it's very interesting to look at the talks. There are some differences between the EU members, and there are countries who are opposing the cuts, there are countries who are pro-cuts, and there are countries who would actually freeze the budget for the next 7 years. What is more interesting is the fact that the policymakers have already decided that if we don't come to any consensus right now, then we might postpone the meeting until the beginning of the next year. So that's not really very
but that's not going to drag on investor sentiment, though, is it? Because it's not going to have an immediate effect on people's investments.
I don't think so. I mean, we have seen that already. The talks yesterday regarding Greece, they haven't impacted the market sentiment that much. So I think people are getting used to the fact that the policymakers are not actually delivering any concrete results, and as such, this might also be the case in case of the budget talks.
Well, that's all for this edition of London Direct. The next time you see me, I'll be in Scandinavia touring the region's biggest banks and hedge funds. But from London, goodbye for now.